Beneath the glitter of every golden age lies a quiet truth. Wealth has never been safe. Not in the days of empire, not in the chaos of revolutions, not even in the supposedly stable decades between wars. From the palaces of Babylon to the villas of ancient Rome, the rich have always played a different game than everyone else. They knew that money, whether in gold coins, grain, or land titles, was never just wealth. It was leverage, insurance, and survival. And while ordinary people trusted the system, the elite learned to protect themselves from the system itself. The question isn't how they got rich. The real question is how they stayed rich when everything around them was falling apart. To understand this, we need to go back to the earliest examples of concentrated wealth, when rich didn't just mean a big bank account, but the ability to control resources no one else could touch. In the city-states of Mesopotamia, 4,000 years before Christ, the wealthiest merchants and rulers didn't just store their silver in vaults. They tied it up in temple loans, farmland leases, and trade monopolies. The Sumerian kings kept their wealth safe by entangling it with religion. The temples were not just places of worship. They were the central banks of the ancient world. To seize a temple's assets would be to offend the gods, and that religious shield made elite fortunes politically untouchable. Egyptian pharaohs knew a similar trick. Their wealth was stored in durable, tangible assets. Fertile land along the Nile, warehouses of grain, and gold mines in Nubia. These were not easy to confiscate without dismantling the state itself. They even used an early form of trusts by dedicating properties to temple estates, ensuring they would pass to their heirs. If you were an elite landholder in ancient Egypt, you didn't worry about inflation. Your wealth was in the land, and the land produced food in a world where food was the ultimate store of value. Fast forward to classical Greece. Here, you see a different approach. Diversification through mobility. Greek merchants in Athens and Corinth made fortunes from maritime trade. They knew a war could erase wealth stored in one city's treasury. So, they kept deposits in multiple city-states, invested in cargo ships, and built relationships with bankers in ports as far away as Egypt. This was an early version of offshore banking, a physical dispersal of assets. If Athens fell to Sparta, a clever merchant could sail to Rhodes and still have enough to start again. Rome took this principle to another level. The Roman elite knew the dangers of political turnover all too well. They saw dictators rise and fall, and entire fortunes wiped out overnight for being on the wrong side of politics. Their solution was a blend of diversification and influence. The richest Romans didn't keep all their wealth in coin. They bought land in multiple provinces, invested in tax farming contracts, and loaned money to foreign kings. By holding assets in territories beyond Rome's direct control, they hedged against confiscation at home. During the decline of the Western Roman Empire, we see a revealing pattern. As the state collapsed, elite families shifted wealth from public assets to private, hidden ones. Instead of lending to the imperial treasury, which might never repay, they invested in fortified estates, private armies, and direct trade networks with barbarian tribes. When Rome fell, the imperial treasury was empty, but the richest families still controlled the land, the food supply, and the manpower. Their wealth survived. The medieval world brought new challenges and new tools. The richest merchants and nobles used the church as both a bank and a legal shield. Property donated to the church was largely untouchable by kings needing money for wars. Wealthy families could park assets in monasteries, keeping them safe. Meanwhile, banking families, like the Medici in Florence, used bills of exchange, an early form of paper credit, to move wealth across borders without carrying physical gold. A Medici could be bankrupted in one city and still be rich in another. So what do all these examples tell us? That protecting wealth has always been about two things: control and distance. Control means holding assets that generate value regardless of the political climate land. Trade routes, resources. Distance means making sure those assets are spread across different systems and jurisdictions, so no single event can erase everything. The rich of ancient times understood something most people still don't. Wealth stored only in the official system is wealth at risk. And that lesson matters today more than ever. We live in an age of instant digital seizure. Governments can freeze bank accounts with a keystroke. Currencies can be devalued overnight. Stock markets can lose a quarter of their value in a week. The ancient elite didn't trust their entire fortune to the state, and neither should you. The tools are different. Now international diversification, precious metals, alternative assets, private holdings, but the principle is identical. History doesn't repeat exactly, but the same traps appear again and again. People assume stability is permanent until the day it's not. The wealthy of the past didn't wait for disaster to strike. They acted early, spreading risk and securing long-term value. That's the real meaning of financial freedom. Not just having money, but ensuring it survives the storms. If you take only one lesson from history, it's this. The system works for those who know how to work around it. The rest find out too late that their safe money was never really theirs to control. If this gave you a new perspective, hit subscribe. History has the answers, and I'll show you where to look.